the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Few hours away from the opening bell. Let's work through the situation together. Equity futures unchanged on the S&P. On the Nasdaq last week, doing nicely on the Nasdaq 100, up every single day with the exception of Friday, up on the week by close to 6%. In the face of this in the bond market, your two-year yield lower again this morning. 2s, 10s, 30s shaping up as follows. We're down 7 or 8 basis points on a two-year throughout much of the last few hours. 376.76 on a two-year going into Chairman Powell on Wednesday. The 10-year down 6 basis points, 336.90. Over in Germany, the German two-year down another 11 basis points, 224, 225. Bear in mind that was 340-ish only a couple of weeks ago, so big turnaround there too. Euro dollar 106.98, euro dollar positive 0.2%. Much confusion, Lisa, about what happens now to the AT1 market, and the Europeans are pushing back against what goes first when banks get resolved.
They say the bylaws say that equity needs to get wiped out first, and they've come out with statements trying to reassure the entire $275 billion market that actually equity gets wiped out and then they take losses, which is different than what we saw in Credit Suisse. So first of all, what lawsuits ensue? Second of all, did the Swiss regulators act single-handedly without really getting any weigh-in or buy-in from the other European regulators? And third, what does this mean in terms of how much confidence people can get if it's sort of changing on a dime?
So there's a bit of a grey area here. There's what's in the prospectus, and it's quite detailed, one. And two, it's perception of this market, and it's what people thought would happen or didn't think would happen. And you heard Greg Peters of PGIM yesterday. There's a really well-educated man in fixed income who turned around and said, I've always struggled with how to value this market. I don't really understand it. And if you didn't understand it before, then maybe you really don't understand it now.
Especially because it's ultimately dependent on contracts. And if the contracts aren't necessarily held in the same kind of way, all of a sudden you start to really raise some serious doubts. Okay, the stocks that I'm watching, I want to go through a number of the banks, both European and U.S. You can see UBS clawing back some of the losses from earlier this morning. They're down now less than 3%, 2.3%. So really trying to reassess whether they're getting a bargain or a bad deal. More people kind of weighing in on the bargain side as time goes on. JP Morgan shares are lower by 0.6%. Not a lot of drama given some potential uncertainty. And Bank of America shares are actually up now 0.3%. In the mid-sized banking in the United States, First Republic shares, yes, they are the outliers in terms of carnage, down 18% about in pre-market trading. But Western Alliance and PacWest, two other banks that we've been watching, are up and up considerably, up 7.3 and 15.8% respectively. I find this interesting because it highlights that perhaps we have gotten to a place where there is more confidence. And I want to end on oil because we haven't really talked about oil. Goldman Sachs came out over the weekend and downgraded their expectation for the full year to below $100 per barrel. You have seen people continually retrace, and you see all the oil majors lower on the day. No drama, all down less than 1%. But still, John, I think it's interesting to note the read-through of what slower economic growth means, tightening credit conditions, and the read-through in different parts of the market of how that's going to really affect growth.
Well, here's the read-through for the Federal Reserve from Goldman Sachs and Jan Hatzius. Here's the first line in their report they put out this morning. We expect the FOMC to pause at its March meeting this week because of stress in the banking system. So they're going with pause. How many others fold going into Wednesday?
Right now, if you base it on the markets, all of them. There are, well, actually around the margins, people are kind of waffling around, but a lot of people are saying, how can they raise rates at a time when something is breaking? And they always said, we're going to hike until something breaks. Well, aren't we there?
2 weekends, we've seen things break, haven't we? 2 weeks of it, and maybe we have another weekend. Jan went on to say the following: while policymakers have responded aggressively to shore up the financial system, markets appear to be less than fully convinced that efforts to support small and mid-sized banks will prove sufficient. Goes on to say this, and I think this is the important line: we think Fed officials will therefore share our view that stress in the banking system remains the most immediate concern for now. Now, the end bit there, for now. Now, is a pause the end, or does a pause lead to the restart if you're able to resilient, or rather insulate the financial system? Do you get a pause and then restart again?
What hazard? That's all I can say. Talk about whether you create a beast here.
Yeah.
Because if you pause and say, we're just going to watch the bank stocks and decide whether or not to hike rates at the next meeting, this creates, again, just the shifting data dependency as to what data you're watching and the relevance of it in a broader sense.
The link between a single 25 basis point hike and a future inflation rate is very tenuous. Goldman went on to say the FOMC can get back on track quickly if appropriate, and the banking stress could have disinflationary effects. That's the take from Goldman this morning.
You know what it says to me?
What's that?
Nobody knows. Nobody knows anything, and people are just basically saying, maybe just wait and see what happens.
That's the one thing we do know.
Yeah, exactly.
But nobody knows. Bill Dudley might know. He joins us now, the former New York Fed president and Bloomberg opinion columnist. Bill, let's go there. Goldman says pause. Pause because of stress in the banking system. Bill, your best guess right now, what would it be?
I think it depends on where we are on Wednesday. I think we know they're not going to raise 50. I think we know they're not going to cut rates. The real question is 0 or 25. The case for 0 is do no harm. We know that the banking system's under stress, so why would you continue to raise rates when the banking system's under stress? The case for 25 basis points is to say, look, we still have an inflation problem. We can do both. We can use our liquidity facilities to shore up the confidence in the banking system, and we use monetary policy to bring down inflation. If I was sitting there, I guess I would probably recommend just taking a pause. But you have to do it in a way that doesn't alarm people. One of the problems of pausing is people are going to say, gee, why is the Fed pausing? Things must be worse in the banking system than we think. I think this is a very different situation than the great financial crisis in the sense that the banks, this is a question of confidence in banks due to uninsured deposits and mark-to-market losses. It's not about the economy that's collapsing. In the last recession, during the great financial crisis, we were in recession beginning in December 2007. We're not in recession now. The economy is actually doing pretty well. And the banks that we're talking about that are under stress in the United States, very small share of the total banking system. So I think it's important to recognize that this isn't the great financial crisis all over again. It's a lack of confidence in banks because especially those banks with a high proportion of uninsured depositors and mark-to-market losses on in their portfolios.
All that said, Bill, do you still think that this Fed should bring a monetary policy, should bring their terminal rate to 6% or possibly above that based on the inflationary pressures if there is this ongoing tightening that people expect from smaller and mid-sized banks?
That's really the $64,000 question. How much is this stress that we're seeing today going to result in tighter credit conditions that are going to change the trajectory of economic growth? I don't think the problem is the credit conditions right now. I think the problem is mark-to-market losses in the portfolio and uninsured deposits. It's very different than the great financial crisis when we had this housing boom and bust. And it was the bust that really took down fundamental values in the banking book and also damaged households enormously because households had used the rise in home prices to pull money out to support their spending. The U.S. economy is fundamentally in better shape today. Household and business balance sheets are strong. So this is, I think, more about confidence in the banking system. One reason why we're having more problems this time, though, last time there were big banks that were willing to ride to the rescue and buy the banks that were under distress. They're much less willing to do that this time because last time when they did this, they assumed huge legal liabilities that they hadn't anticipated. The second reason why big banks don't want to ride to the rescue this time is if I buy a bank and get bigger, I could be pushed into a higher, what's called a SIFI surcharge bucket, with a higher capital requirement based on my size and complexity, which would apply to my entire book of business, not just the new part that I just acquired. So you don't have the, people that come in to, buy the banks that are under stress like you did last time.
Given that you don't see this as a 2008 redux, maybe you don't get the white knights coming in to bail out these banks with an acquisition, as you point out. But a lot of people are writing into me and saying you live under a rock of bearishness. You don't understand the momentum that you're seeing throughout the world and throughout a lot of communities in the United States. Given that there is this sort of momentum, do you think that it's folly for people to be pricing in significant rate cuts, more than 100 basis points of rate cuts from now until the end of next year, or until the end of January next year, I should say?
That seems very premature to me. I mean, that means that the Fed has basically failed in terms of providing a credible liquidity backstop. And I think the Fed can succeed in providing a credible liquidity backstop. In fact, the steps they've already taken, I think, go a long way towards that. I think the Fed, if I were sitting at the Federal Reserve right now, I'd be asking myself the question, how can I do more on the liquidity front so I can free up more flexibility on the monetary policy side? Because if we can restore confidence in the banking system, then the Fed can use monetary policy to bring down inflation.
Do you live under a rock of bearishness? Is that what someone said to you?
People, well, not in that many
That's
words.
pretty
but
brutal,
no, they say other things, like you're a pessimistic, horrible human who doesn't ever think positive things. But I do. It's just that I worry.
Who says that to you?
Oh, a lot of people,
It's nasty,
but
Brahma.
It's
we
okay.
all love you. It's
Oh,
okay.
that's sweet. But it's okay. I can deal with it because I'm prepared, because I'm duly bearish. But I'm not. It's just realistic. It's trying to understand the unknowns.
Looking around corners.
Exactly.
I get it.
Thank
Thank you. Bill, a couple more questions if I can. I got this one over the Bloomberg moments ago. And someone watching wants to know whether you think the gap between Fed funds and bank deposit rates matter here. Has that contributed to the problem?
I think banks have been slow to raise their deposit rates because they've been awash with deposits. I mean, what happened when the Fed was doing quantitative easing was buying securities, and that cash from those securities purchases was actually flowing into the banking system. So banks have actually been pretty slow to raise their deposit rates. When people look at the mark-to-market losses on their securities portfolio and their loan book, that has to be offset by the fact that banks are actually doing quite well in terms of the deposit base. The value of a retail bank network today, branch network today, is much greater than it was when interest rates were at zero. So when you're looking at the banking, asset liability mix, you also have to count the value of those deposits, which is really quite high right now. For most banks, net interest margins have actually been expanding. Silicon Valley Bank was a very important exception.
Bill, I just want to weigh in as well on the balance sheet. I'd love your thoughts on that. As we know, there's been a rush to use the discount window. The new facility that was opened by the Federal Reserve just last weekend will encourage perhaps more of the same. Can you tell me whether, just because the balance sheet is expanded again, whether that means it's the end of QT? How do you think about these things?
I think this is about exceptional liquidity, lender of last resort provision to support the banking system. I think quantitative tightening, the runoff of the Treasury portfolio and the agency mortgage-backed securities portfolio is going to continue unabated. I see these tools as very separate and different. So I expect that the quantitative tightening will continue.
Bill, wonderful to get your thoughts. As always, Bill Dundee there, the former New York Fed president and Bloomberg opinion columnist, going into Wednesday with Chairman Powell just around the corner.
Do you think he's just sort of sitting there in his room? Like, why me? Why do I have to do this?
Chair Powell?
Yeah.
You think that's how he psychs himself up?
I don't know. What do you think he does?
The Fed decision.
Does the Rocky soundtrack?
No idea.
Does
he ride his bike or something like that?
Oh, I could get into that.
Couldn't really care less. Equity futures on
How
the
do you really feel?
negative a tenth of 1%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Central banks worldwide are endorsing Credit Suisse's rescue after UBS agreed to buy the Swiss bank for $3.2 billion in a government-brokered deal. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell welcomed the news and said that capital and liquidity of U.S. banks is strong. Both the European Central Bank and Bank of England also endorsed the actions taken by Swiss authorities. First Republic is set to extend its record loss today. Shares of the bank are plunging in pre-market trading after S&P Global Markets cut its credit rating again. Last week, some of the biggest U.S. banks pledged $30 billion in cash for First Republic in an attempt to stem the turmoil. Donald Trump's claim that he'll be arrested Tuesday has Republican Party leaders rallying to his side. The former president wrote on social media that he expects to be arrested as part of a New York investigation into hush money payments to an adult film star. He urged his supporters to protest. The European Union is set to agree on a plan to send Ukraine 1 million artillery rounds over the next year. Foreign and defense ministers are expected to reach an agreement today. They'll also approve spending more than $1 billion to reimburse EU members who send Ukraine shells from their own stockpiles. And Volkswagen is planning an even cheaper electric vehicle. VW brand Chief Thomas Schaefer told German magazine that there could be a model selling for less than $22,000 as early as 2026. Last week, VW unveiled an EV that will sell for less than $27,000 when it reaches showrooms in 2025. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We've had a recognition that the inverted yield curve has, hampered the balance sheet on a paper basis of some niche banks. And when the first crisis happened in 2008, the whole issue was systemic collapse. We don't have a systemic collapse now. We have a crisis of confidence, and that crisis of confidence can ratchet into a bad economy.
Just a fantastic lineup of guests yesterday for a special coverage on Credit Suisse and UBS. UBS taking over Credit Suisse for $3 billion. Mohamed Al-Arian, and on Twitter in the last 24 hours, a 167-year-old institution. He said Switzerland's second largest bank, a bank that opened its doors for business in 1856 and was one of the 30 systemically important banks around the world, will no longer exist as a standalone entity. Lisa, I think we have to step back and just take in the gravity of the moment. 167 years old. And here we are, Credit Suisse, essentially no more once all is said and done.
And when you take a step back even further, Switzerland, known for its banking industry, its banking complex, for a safe haven for capital from all over the world, now a one-bank town when it comes to systemically important major global banks. What are the ramifications of that? What does that mean? What happens in this integration, especially as UBS is now saying that Credit Suisse is still considered a competitor? I mean, really, we don't understand the process yet.
It's tough to get your head around, right? Exactly. Super tough. I think that's one way of motivating your employees or something like that.
To do what?
After the weekend. I don't know, not to be distracted by what's happened over the last week. Tremendously difficult to do.
Talking about employees in this bigger picture, how do you then communicate to everybody to come in every day and work their hardest in this morass of uncertainty that we continue to see develop in real time.
UBS down about 4% in Swiss trading. That's a recovery from where we were, down about 15, 16% a little bit earlier. I mentioned a call from Goldman. Jan Hatzius at Goldman Sachs, they now expect a pause at the March meeting, their line, because, quote, of stress in the banking system. Neil Dutter of Renmark just wrote in, he said the following: normally I'm not one to think about the Fed knows something that the market does not. If all we are doing is talking about economic data, I don't think the Fed has much of an edge at all. But given the specific set of issues we are dealing with around the banking system, this period is unusual. The Fed might actually know something we don't, which is why the signaling on Wednesday, Lisa, becomes that more complex.
Given the fact that the economic data does not justify a pause in any way, shape, or form, right? I mean, to that point, if they pause, it's not because of economic data, and they do have intelligence when it comes to the banking complex. So I think it's a good point. How do you deal with that, given where their knowledge is and where it isn't, and what their data dependency actually is?
Let's get to our next guest. Joining us now, I'm pleased to say, Mayra Rodriguez Valadares, Managing Principal at MRV Associates. Mayra, thank you for being on the program with us. Last weekend, it was Signature, it was SVB. This weekend, it was Credit Suisse. What are you expecting next weekend?
Right. That's really the question. I'm afraid that the regional banks in the U.S., of course, are still very, very sensitive to this crisis in confidence, frankly. But the demise of Credit Suisse is very, very different. And unfortunately, I heard some Swiss regulators and government officials blaming the U.S. banking chaos for the Credit Suisse demise. And this one cannot be pinned on the American banking sector. Unfortunately, kleptocrats and crooks have long been banking at Credit Suisse. It has decades-long, unfortunately, history of many, many scandals. So if anything, I would really be worried about those really big banks that have weak operational risk. That's what we really need to be looking at.
We just had Bill Dudley, the former president of the New York Federal Reserve, and he was talking about how the one difference now, or one of the main differences now from 20 years ago, is that big banks don't want to acquire other banks so quickly. The litigation risks, the regulatory risks that accompany that are significant and opaque. What do you make of that in terms of how many provisions had to be put around the UBS acquisition of Credit Suisse, and what that means for distress that we're seeing in certain pockets in the U.S.?
He's actually right, because the big banks have a lot of interconnections. There's just a tremendous amount of opacity that investors don't know. And I think that that's what we really should be focusing in the coming days, because right now everybody's trying to go through all the fine print of the memorandum, of the UBS memorandum of the takeover of Credit Suisse. But imagine all the opaqueness in the banks, especially in Credit Suisse. There's a lot of duplication. There's going to be, unfortunately, thousands of people who will be fired all over the globe because, of course, UBS will get a say as to who gets to say. You have shared facilities in terms of liquidity. You also have a lot of systems at both banks, many which are legacy systems. And so UBS is going to have to be combing through this all very, very carefully. Are there hidden liabilities at Credit Suisse that UBS hasn't had a chance to find out? There is no way that they were able to do all this level of in-depth due diligence to be able to do this deal. And so that's really what UBS and any big bank would be worried about in terms of trying to buy out another one.
There are two issues here. There are a lot of issues here, but there's what's going on with Credit Suisse and UBS, and there's what's going on over in the U.S. and some of the regional banks. The interlinkage, perhaps, is a confidence story, but the stories are separate in what is going on and why. And I want to just go to the U.S. story for a second, Mayra, and this question of supervision of the Federal Reserve and the role of people to identify problems and adequately prevent against them spiraling out of control. What is your concern level in the inability to do that with Silicon Valley Bank and some of the others that have drawn scrutiny recently?
Yes, I'm glad you said the word supervision, because that's really, we need more supervision, not necessarily regulation. However, having said that, if big banks were required to be called systemically important, which is exactly what the Trump law deregulated, then those banks, the size of Silicon Valley, would actually be disclosing more about their liquidity, the composition of their deposits. And in the US, we have a very complex regulatory and supervisory framework. You have the state regulator. So state regulators often do not have the money. They don't have the resources, and they're the ones that are right there on the ground. So the state regulators are the ones that have to be empowered, and the banks should be required to disclose more about their liquidity, their capital, their other kinds of risks such as leverage, the concentration. If investors had that information more often than just once a quarter, they would be able to discipline the banks. You cannot count on regulators or rating agencies to discipline the banks. But the banks are opaque, and they should really be disclosing a lot more about their concentration and liquidity risks.
Myra, bank failures, as you know, go back centuries. And I wonder if our biggest problem right now is the fact that banks fail, or the fact that seemingly we can't tolerate failure anymore.
That's exactly it. You have to let banks fail. The problem, of course, is that the people who are going to get hurt are the junior level employees, the ones that aren't getting the big bonuses, all the restaurants and hotels anywhere that had any business with those banks are the ones that get hurt. And we're no longer really a capitalist society. We are constantly letting these bank executives socialize the losses, and that's the problem. They should be allowed to fail. There should be clawbacks for bonuses, and you have to discipline rogue professionals at these banks. Otherwise, we're constantly doing this, and it's always the taxpayers that are bailing out the banks, I should say. And it's a problem for all the different kinds of central banks. The Fed now is probably not going to be able to raise rates, but it's not just because of what's going on in the U.S. I mean, do you think that Switzerland right now could raise rates, or the European Central Bank? We have global inflation, but now come all of these problem banks. And so it is really going to be quite a challenge for all of these different central banks, as well, of course, as the bank regulators globally. This is not just an American problem.
Myra, let's catch up soon. Appreciate your time this morning. Thank you. Myra Rodriguez Valadares there of MRV Associates. Not really a capitalist society anymore. It's quite a line, isn't it?
You get a prize. You get a prize. Everybody gets a consolation prize. Is that basically the implication that banks are not going to be allowed to fail? Because we did see Silicon Valley declare bankruptcy, and it is going to be broken up. But at what point can you ensure that there is a penalty for not taking the right risk prevention measurements? I mean, that's really what happened with Silicon Valley Bank in particular.
Politics happen too. Let's be clear about that. You know, politicians understand that there is some fallout to letting things fail. They know how this plays, which is why they're so keen to say this wasn't a bailout, it's not a bailout, it's not a bailout. And of course, we all know, I mean, how can the Swiss come out and say this is not a bailout and offer at the same time a government guarantee? How does that work?
How do you game out, though, what's going to generate more losses for the taxpayer? If you want to go there, is it going to be creating a backstop to a bank, or is it going to be assuming the losses from whatever panic or whatever whatever deterioration in credit ensues from that?
Equity futures right now down about 1/10% on the S&P. No drama there. UBS at the moment down, let's call it 5% on UBS. First Republic right now down about 21% in the pre-market. Matt Brill of Invesco up next.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky...
Connection lost.
Rambo.
Rambo.
Easy. Not even a fight. Unless it's in a ring, See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
That a swift and stabilizing solution was absolutely necessary. And this solution is the takeover of Credit Suisse by UBS.
This was not the best solution, but it dominated the other two, which was either nationalization or trying to wind down the bank.
The banking sector, it runs on confidence. We just need to see what the sentiment is out there.
The system is very fragile in the banking system, right? Companies are levered. I think they're well managed, but when things get exposed or moved, it moves quickly.
For sure, it's going to bring down inflationary pressures. I'm anxious to see what the Fed does on Wednesday.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a weekend in Switzerland. Another cliff-edge deal to close out a week. This time it's Credit Suisse taken out by UBS for $3 billion. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures right now on the S&P totally unchanged. First Republic's down about 20%. Lisa, UBS is down about 5%.
Which is retracing some of the losses from earlier this morning. The unknowns really percolating through the uncertainty that we've been hearing from all of our guests throughout the morning, as well as the sense in markets of trying to game out whether we've restored confidence. Have we? Maybe not in First Republic, but maybe in some of the other regionals.
Sticking plaster or solution?
This is the question. Right now, it's not quite a solution yet. Can you really call this a solution when we have no sense and there's still people raising questions? I think we're going to hear from Fed Chair Jay Powell on Wednesday. Was this enough to put them on pause after just a week ago people were calling for a 50 basis point rate hike?
I've got a rule. If you have to say idiosyncratic on 3 different issues, you've got one big problem.
That's a journalism rule. Basically, 3 examples makes a trend.
You know, come on.
I think that you're right in the sense that that's what everyone's looking for, and you're seeing that flight in real time. That said, at what point does this cause some kind of contraction in the credit impulse? And I think that this is really a question that we've rolled with, that basically this would lead to a tightening in credit conditions, particularly at regional banks. And yet we heard there from Gerard Cassidy of RBC earlier this morning. He's not seeing deposit flows, and we are seeing ongoing credit creation given the strength in the economy that we've been talking about for the past couple of months.
If you are just tuning in, we're already getting some calls from Wall Street economists looking ahead to Chairman Powell on Wednesday, and those calls are changing. This from Jan Hatzius at Goldman. We expect the FOMC to pause at its March meeting this week because of stress in the banking system. Now, pause. Pause to some people means that's the end. Pause to some other people means, well, that's the end for now, and then we restart hiking later on in the year. What does pause mean to you if we get one on Wednesday?
To me, it means the end of the cycle.
Certainly the market reflects that view.
That's what I would say, because at this point, how can they say the turmoil has been enough for us to stop hiking rates, for us to shift our focus from the economic data that has come in hotter than expected on several occasions, numerous consecutive readings, and say this is a change in circumstances where something broke? If they say that, how can they then go back and say, no, nothing broke, we're all good? I mean, really, this is the conundrum that they're facing, but the market is pricing in 100 basis points, more than 100 basis points of rate cuts through January of next year.
Equity futures right now on the S&P, totally unchanged. Let's give you a flavor, a snapshot of the price action about 90 minutes away from the opening bell. Equity's not doing much. The bond market's doing something. We've got a rally again. Yields are lower by 6 basis points, 336.90, 337-ish on a 10-year. On a 2-year, we're down by about 10 basis points to 374. The 2's10 spread now is only negative 36 basis points, and a few weeks ago it was something like negative 110. Was that after ADP? Do you remember that? It was negative about 110.
Yeah.
Huge turnaround, delivered really by what's happened at the front end of the curve.
Given the fact that people are ratcheting back their expectations for rate hikes, and you're seeing the long end of the curve, also yields come in, rally pretty steeply, but really it is the short end. We have seen a complete repricing of Fed rate hikes.
I think regulators worldwide just doing copy and paste from other people's speeches. This comes from the UK, the spokesperson for the government. We believe the UK has a robust banking system. Have we heard that from the US? Yes. From the
Australia?
Europeans? Yeah. From Switzerland? I think we heard that yesterday, didn't we?
Yeah, and even Australia. I mean, it's sort of the Australian monetary policy. They came out and they were like, our banking system is strong. This is sort of the cut and paste of central bankers.
They're kind of damned if they do and damned if they don't, right? If they don't say it, then you're like, why won't they say it? Why won't they say it? Maybe they don't.
Press paste.
Bloomberg's Francine Lacroix has done a phenomenal job of pushing this story forward over the last week. She joins us now from Zurich. Francine, does Switzerland now have a robust banking system?
Well, though, pains at saying that they have a robust banking system. I did actually speak to a couple of people on the ground just 3-4 days ago saying that the Swiss regulators were a little bit slow to the game. They took issue with the fact that Emmanuel Macron, they took issue with the fact that, for example, in France, regulators, as soon as something happened with Credit Suisse, as soon as Wednesday and Thursday, came in and saying, guys, we've got this. So we did see the story developing very, very quickly in the last 2 to 3 days, but there is still a nagging feeling that maybe they could have placated it very quickly. John, the state of play is, look, there's now a lot of chatter on whether they should have done something differently with the AT1s, not wipe them out, maybe convert them into equity, and then taken a haircut on that. But this is where we are right now. The system is what it is. We had assurance from the chairman of UBS that he will go ahead with the deal. That, remember, was in question less than 24 hours ago if the CDS blew up. And so we'll then see what they do with the investment bank, with the Swiss Universal Bank, and we'll see how markets react to the rest of the European banking sector.
Francine, you're in Zurich there, and I'm wondering about the psychology of this tie-up, given the fact that Switzerland is known for its banking complex, and now effectively it is a one-bank town with UBS, the dominant global bank.
Yeah, the psychology is one of shock. I mean, even if you spoke to the people on the press conference yesterday, it's one of shock. They can't really believe that this unraveled so quickly. Remember, a week ago, we were talking about Credit Suisse that had a lot of problems, but that was still sound. It was a bank that was well capitalized. So they cobbled together this deal, maybe giving, Credit Suisse for too much of a cheap price away. But the reality is that UBS didn't really have time to do any due diligence properly. So they've tried to backstop, get as many guarantees as they can, even with the AT1 that they use for capital, to make sure that if there's anything ugly that they need to unwind in parts of Credit Suisse, they will have enough capital to do that. I mean, the question is, you're right, one of regulatory concern. If you have a massive Swiss bank, does the regulator go and give its blessing? We tried to speak to the FINMA chief executive. He said, look, that's probably the case. But what I suspect is that that. They'll absorb it and then break bits off, because that, frankly, is the only, the only thing that makes sense going forward. So they don't keep everything. They take it, look at it, job losses, job cuts, and then you see what else you can spin off.
Hey, Francine, wonderful to catch up once again. Francine Lacqua there from Zurich on the latest with Credit Suisse and UBS. UBS is lower by about 5.5% in Swiss trading, well off session lows. We talked about it in the last hour. Here's an institution, opens its doors in 1856. The test of time, goes through all of it, 2 world wars, still standing, and this is it. This is it.
There was a lot that built up to it. Let's be honest, right? So this has been in the works, right? This has been a tumultuous period with a lot of scandal and issues that really emerged through all of this. That said, was there a trigger in Silicon Valley Bank, a mid-sized bank in the United States, that led to this, as a lot of Swiss regulators are basically saying?
Swiss officials in that news conference, one by one, all basically saying that it was about what happened in the US. You don't buy that. I'm not sure many people do.
It raises a question of what does systemically important mean if a mid-sized regional bank could cause the demise of a Swiss behemoth.
Matt Brill joins us now, head of North America investment grade credit at Invesco. Matt, the key there, investment grade. Some of these banks we're discussing a few weeks ago were IG. Make sense of that for us all.
Hey, good morning, Jonathan. Yeah, it's almost unimaginable what's occurred in the last 6 days. You think about banks in general, they're founded on confidence, and when confidence just evaporated, so did their ratings, and so did the bank. And that's essentially what happened in 2 different places or 3 different places. And now everybody's questioning where it goes from here. I think in terms of where you should be trading, because it's hard to analyze this right now. You got to be getting paid more to own these banks, because a traditional industrial can't default in 2 days. It can't default in 48 hours, even unless there's fraud, which makes this just a very different situation in the bank space. And that's why nobody has any confidence in owning it right now, and the credit spreads continue to sell off. And it's certainly a challenge to navigate. And this could have been analyzed, but when confidence goes away, it makes it all the more difficult.
So Matt, at this point, is it really holding a falling knife? Is this basically liquidate positions, try to understand the risk before diving back in?
I think that's what most people are doing. Certainly, yes. I mean, I look at risk managers; they're telling you to own less than what you owned yesterday. That's the number one mandate. Whatever you own today needs to be less than it was yesterday. I think you've got quarter end coming up, which is clearly going to be some window dressing ahead of that. I think the banking system is going to get through this. I actually think the solutions that have been proposed and brought out, I think are going to work. Everybody just needs to calm down, which is hard to get people to calm down. When somebody tells you calm down, you never calm down. But we got to get through the next week. And at the end of the day, these are sound financial institutions. But if there's no confidence, then there's no ability to have a foundation there. And I think that's just the problem. Is we just got to keep talking this up. And as you stated, everybody's going to tell you everybody's fine. And that will eventually get cooler heads to prevail. But it's just a very, very volatile period of time. And until we get through that, everyone's going to want to own less.
Matt, you said the solutions they've proposed. What are the solutions they've proposed that you think are really going to resolve this issue?
Well, I think that the bank facility window was a great one in terms of not having to crystallize the losses. That's essentially what took down SVB. All these treasuries, which were trading at a huge discount, now they've come back quite a bit with this rate rally. If you don't have to crystallize that loss, I think that's huge. I think that can, we don't have an asset quality problem. We have a liquidity problem. But as long as this persists, it eventually create an asset quality problem. So the Fed is giving up as many liquidity lines as they possibly can to make sure that there aren't more dominoes to fall. And I think that the liquidity they're pumping in the system should work. It should restore confidence. But again, we just need a few more days of not having the next domino to be in the news, which would certainly help.
Matt, you said something earlier on in the conversation to Lisa that stood out for me. The way we assess the risk around financials relative to all other industry groups, because banks can fail so quickly, so fast, just like that in a couple of days, seemingly. Matt, do you see that as a permanent shift or something that's resolved in time, weeks, months, quarters?
So you saw after the financial crisis, bank spreads traded well back of industrials for roughly 13 years. And then they finally kind of got back in line, call it 2021, somewhere around there. So it's going to take a long time. I think absolutely regional banks are going to trade cheaper. You're going to see the big six will trade better, but I still think those have to probably trade cheap to industrials as well. So this is not going to be fixed overnight, even if the Fed continues to talk this back up.
Matt, they're playing the music, which means I've got to go. So you've got to do one-word answers. 25 or 0 on Wednesday.
25.
25. Matt Britt of Invesco. Thank you, sir. From New York City, futures negative 0.1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shares of UBS are lower after it agreed to buy Credit Suisse in a historic deal aimed at containing a crisis of confidence. UBS is paying $3.2 billion in an arrangement that includes extensive government guarantees and liquidity provisions. The price per share marks a 99% decline from Credit Suisse's all-time high in 2007. U.S. regulators are now moving toward a breakup solution for the collapsed Silicon Valley Bank. Bloomberg's learned the FDIC couldn't find a suitable buyer for the entire bank. It's looking to sell it in at least 2 parts. The rout in oil prices resumed today. West Texas Intermediate fell below $65 a barrel at one point, while Brent dropped below $71 after last week's 12% decline. Concerns about a global banking crisis is hurting demand for commodities and other risk assets. China's President Xi Jinping is making his first state visit to Russia since it invaded Ukraine. Now, 3-day trip that begins today is a strong show of support for Vladimir Putin. Xi is likely to discuss his 12-point blueprint for ending that war. Now, the plan has been dismissed by most Western governments. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City, London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
He's there to kind of upside.
Was going to keep rain World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
After a week of turmoil, what's the Fed's next move?
The job of reducing inflation is not over.
Are they worried about the signal it would send if they did nothing?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Central banks groping their way through a dark room, looking for Schrodinger's cat.
Does this indicate that the Fed is petrified?
Does bank supervision take precedence?
If you want to fight inflation, you better sort out your financial system first.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
One of the problems of pausing is people are going to say, gee, why is the Fed pausing? Things must be worse in the banking system than we think. I think this is a very different situation than the great financial crisis in the sense that the banks, this is a question of confidence in banks due to uninsured deposits and mark-to-market losses. It's not about the economy that's collapsing.
This is a difficult moment for Chairman Powell and the FOMC. That was Bill Dudley, the former New York Fed president, catching up with Lisa and I in the last hour or so. what do they do when they understand there is a signal that you send when you do something, and also a signal you send when you choose not to?
You know, we were saying this before the ECB meeting last week, and we said, what do they want to do? We don't want to be Christine Lagarde. They clearly were debating it. They came out with a 50 basis point rate hike. And actually, it probably was the right thing based on market response that day. Whether it was this week, we'll have to see. But, you know, my point is, it's hard to know what the market response will be to the decision, let alone what the decision is.
Well, everyone's pretty split because no one really has any idea.
Correct.
So Goldman and Jan Hatzius have come out and said this morning, we expect the FOMC to pause at its March meeting this week because of stress in the banking system. That's Goldman. They're at pause. Matt Brill, Invesco, 5 minutes ago. Same data in front of us all is basically saying, no, they're going to go 25.
So if financial advisors are therapists to their clients, how are they giving them therapy when essentially they're saying, you're asking me, I have no clue? This is really the sort of conundrum that people have. Where do you get a guide if this is really a moment that we haven't seen before?
I've always said that FAs are meant to be market therapists and they should do courses in psychology.
I think that they do.
Some of them do.
Yeah.
The smart ones do. Equity futures right now, I'm not saying all the other ones aren't. Anyway, on the S&P right now, down 1/10%. In the bond market, yields in 3 or 4 basis points, 339 on a 10-year. On a 2-year yield, we're down another 7 basis points to 377. We're taking out more hikes. We're pricing in more cuts. It's not just the US, it's Europe, it's the UK. Take your pick. The BOJ just never joined the party, and maybe there won't be one over in Japan after the events of the last few weeks. But again, who knows? Michael Arrighetti joins us now, co-founder and CEO at Eris Management. Michael, wonderful to catch up with you, sir. I think we need to talk about speed, just how quickly this is moving. What do you make of it all?
Yeah, I think you hit on a big challenge in today's market environment relative to past cycles. I think with the speed with which money can move through the system, the speed with which information is coming at us, it's getting harder and harder to distill the signal through the noise.
So we're talking with you, Michael, at a time when people are wondering who will take over some of the institutions that are seeing some distress, who will come to the rescue. And we were talking with Bill Dudley about how big banks learned their lesson during the financial crisis and are concerned about litigation risks. From your vantage point, given that Ares oversees $352 billion of assets, including more than $200 billion of credit, what's your view on that? Where is your role?
It's interesting. I think the private credit markets have been playing a little bit of a stabilizing role here over the last couple of weeks and months as liquidity in the traded markets is not what it used to be. I think folks like Ares are coming in and really providing liquidity in certain markets where liquidity has gotten thin. One thing I think about now as one of the larger private credit managers is we don't know exactly how this all will unfold, but I can tell you one thing, we will see more regulation of banks, both mid-sized and large. We will likely see a change to bank capital regulatory framework here in the US and abroad, and that capital contraction will make it ever more important that private credit plays a role in funding the real economy.
So at what point, and I want to go to the funding the real economy in a second, but just in terms of the here and now, is Ares going in and picking up bank bonds? Is Ares coming in and discussing how to finance banks that perhaps are threatened with deposit outflows?
I mean, I remind you, Lisa, we play strictly in the private market. So we do have certain pockets of capital within our opportunistic credit and distressed businesses that will dabble in the public market opportunity that gets created here. But the opportunity set for Ares and those that look like us really is to come in and be a liquidity provider to the small companies that may be challenged to get liquidity from mid-sized and regional banks. And it could be as a real good counterparty to the banks on reg cap trades as they try to revisit the liquidity on their own balance sheet.
You talked about the broader capital sphere that we're watching and this concern about whether commercial real estate operators as well as individuals and small businesses can get the loans that regional banks used to provide to them. Michael, private credit might step in, but how much more expensive will it be to get it from a private equity company or a private debt firm than from a regional bank?
Look, I think historically the private credit markets have been more expensive. That's largely because they tend to provide a level of creativity or innovation or frankly more leverage or structural flexibility than a bank solution could. So I think the market is pretty well attuned to a higher cost of capital. I think you raise an important point though here is what we're dealing with now is liquidity and duration, not credit. We're already seeing the impact that cost of capital is having as rates are moving up so quickly. I think we first need to get to a point where the equity valuation environment adjusts to the new realities so that people can actually afford a higher cost of capital if that's where this takes us.
Michael, one issue that's come up repeatedly over the last week is this idea that ultimately now we'll end up with tighter lending standards, tighter financial conditions. I think a lot of people are lining up to give us the stats about how dependent certain parts of this economy are on the financing from small and medium-sized banks. We're thinking about real estate a whole lot more. Michael, how are you thinking about the ripples from what's developed in the last couple of weeks from these banks and what regionals are going through and what it means for an asset class that I imagine you're exposed to?
Look, I think it could be very challenging. I think that the Fed is doing everything it's supposed to do to step in and provide confidence. I was pleased to see the larger banks in the market step in to provide support to First Republic. I think at the end of the day, again, this is duration, liquidity, and confidence, not credit. So I would hope that folks calm down, again, see the signal through the noise and get back to lending. But it is a real risk. Obviously, to the extent that people continue to lose confidence, capital leaves that part of the banking sector, and it is going to make it harder for people to access capital for sure.
It feels like a year ago, but last week, Larry Fink of BlackRock said that there are a number of shoes that are going to drop. First, it was Silicon Valley Bank, then it was other smaller and medium-sized banks, and next it would be the private credit and private equity and venture capital markets that wouldn't get that credit. Do you agree with that?
I think one thing that is probably most misunderstood about the private markets, which is why, it's always been this view that they're the canary in the coal mine, and yet every time we have a crisis or a mini crisis, private markets tend to emerge fairly unscathed. And I think the big difference that folks don't really appreciate is, one, most private credit assets are held unlevered. To the extent they're levered, they're modestly leveraged with match duration and match funding. Juxtapose that with a bank that is 10 to 15 times levered, and you get obviously a much different outcome in markets like this. Similarly, on the equity side, they are operating out of funds with 10 to 12-year life cycles. And so most private owners of assets that are institutionally backed are neither forced sellers or forced buyers in any market, and that provides a level of stability that I think people may underappreciate when we go through markets like the one we're in right now.
That's a constructive point. Michael, got to leave it there. It's wonderful to hear your thoughts. Thank you. Michael Arrighetti there of Ares Management. What do you make of that, Lisa?
A lot of people have been talking about this, that basically if you don't have to sell, they can ride through without the constant real-time pricing. I might argue it depends on what sectors you're exposed to, because if you're exposed to certain companies in Silicon Valley, it might happen perhaps a little bit quicker than the maturity that you have. So I think that probably people are parsing through exactly who the companies are, but this is a point that's been made. The liquidity mismatch isn't there to the same degree.
The speed at which this has moved.
Exactly.
This has moved so quickly. 2 weeks ago, Chairman Powell sitting there. Not even 2 weeks ago. No. Chairman Powell opening the door to go 50. People are lining up and saying, how low's the bar? Now we're talking about how high's the bar to go 25.
Is it Twitter's fault?
It's Twitter's fault.
Is that the reason why?
According to certain officials around the Credit Suisse story. Okay, next hour, Bloomberg TV, Mana Mahajan, Edward Jones, Gagi Chowdhury, BlackRock, David George of Baird, Daryl Cronk of Wells Fargo. Looking forward to that. And Lisa's going to catch up with Leon Cooperman in the next 30 minutes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Welcome back. This is Bloomberg Surveillance. After a morning of turmoil trying to parse through what it meant for UBS to agree to take over Credit Suisse in a deal very much facilitated by Swiss authorities, we are seeing the market reaction with UBS shares sharply lower. Initially, they have retraced some of that in the markets, a churn in the U.S., basically unchanged in equity futures. UBS has retraced a lot of it to only 4.4% in terms of a decline. In the bond space, the move is much more clear. That is yields lower, price up, both in the U.S., both in Europe. We're looking at two-year yields now 3.8%, off earlier lows, but still down from more than 5%, nearly 5.1% at the high earlier this month on March 8th. Over in Europe, you're seeing that two-year yield in Germany down to 2.28% from a high also on March 8th of 3.3%, just a complete retracing. Euro strength, what does it mean for Europe to be raising rates at a time when the U.S. might be on pause? That is the question facing Jerome Powell on Wednesday. That was the question facing Christine Lagarde last week. She speaks again. Maria Tadeo of Bloomberg in Brussels right now. Maria, what are we expecting to hear from Christine Lagarde at a time when she made her move? She said that they have unique tools to deal with any kind of systemic issues in the financial system. Will she pull that back a little in terms of reasserting future rate hikes in the ECB?
Well, look, what a situation she finds herself in, because when you look back to last Thursday, and obviously she went in for those 50 basis points and then made it clear that the European Central Bank does not see a trade-off between price stability and financial stability. That was a press conference, and I must say a number of sources told me was one of her best press conferences to date. That was a tick. That was well done, Madame Lagarde. Now she finds herself 4 days later here in Brussels, now having to instill confidence in a market where obviously the jitters continue, and having to once again reassure not just investors, but essentially now general population. I mean, this is a huge talker in Europe about the health of the European banking system. So again, what a communications exercise from Madame Lagarde. The one thing that I would point, though, is beyond that statement from the ECB yesterday, this session today, this was already on the agenda. We were expecting that she'd be here in Brussels today. This is a meeting that happens regularly, but obviously today it will be all about the banks. These will be the questions the lawmakers will put to her, and of course that's the focus point for us too.
Maria, when we talk about confidence, I have to just drill into this one instrument that a lot of people haven't heard of yet, the contingent capital bonds, the AT1 market, the $275 billion of debt, now called into question after Credit Suisse's debt essentially was written down by Swiss authorities. We're hearing some pushback from European authorities saying, no, actually, equity has to get wiped out before these instruments. Is there a bit of a tiff emerging between European regulators and Swiss regulators that acted alone?
Yeah, and I think you read it quite well. And if you look at the statement last night, and to me this is very telling, and I wonder what you think of it. If you look at the statement yesterday from the European Central Bank, and you read between the lines, essentially what they said was, thank you to Switzerland and UBS for essentially stabilizing the situation, alongside repeating the European banks are solid, they're well capitalized, and there's liquidity. If you look at the statement from the regulator today, it's a different note. Essentially they say, and I want to read it just to be very accurate here, it says, obviously the common equity instruments are the first ones to absorb losses. Only then after you would look at AT1s. And then this final line, which to me is crucial here from the European regulator, again, goes back to your point of whether or not there's a subtle criticism here. It says additional tier 1 is and will remain an important component of the capital structure of European banks. I think that tells you a lot in terms of just how much perhaps the sentiment has changed overnight to the morning, when you actually now have the time to figure out the details of a deal like this.
And let's see as market participants parse through it as well, because you are seeing those contingent capital bonds, those AT1 notes, severely repriced lower this morning. Maria Tadeo, thank you so much, and we will be catching up with you throughout the morning. I do want to bring you some news. The FDIC just releasing this, extending the bid window for Silicon Valley Bridge Bank. This question of whether there are buyers, we've asked this. Why did nobody show up, or did anyone show up to the auction, the effort that the FDIC made to try to find some buyers? They say that now they have substantial interest from multiple parties. What that interest looks like, how that comes in, remains to be seen. The FDIC says bidders need more time to explore all options. So how much is this due diligence to understand all of the potential liabilities? We will bring anything to you as we parse through some of the documents and what they have so far. Tiffany Wilding has been studying this throughout the ups and downs of all of the rate hiking and the rate cutting expectations. She's North America economist at PIMCO. And Tiffany, you came out with this question of whether they hike or whether they don't hike is kind of not the issue anymore. It's when do they start cutting? Tiffany, from your vantage point, what is the answer?
Yeah, well, I think it's going to really depend on how quickly this situation escalates. You know, really the issue here is how tight are financial conditions. You know, and clearly what this whole situation has revealed is that they're actually really quite tight. I think that there is a lot of question around that, you know, because, you know, that maybe the impact on the economy or the labor market was a bit slower than some had expected, you know, but these things happen in a nonlinear fashion. You know, and so I think what this situation revealed is that actually financial conditions are quite tight. You know, and I think the question for central bankers will be, you know, have they tightened so dramatically as a result of the bank stress, which is going to put pressure on lending? You know, have they tightened so much that, you know, that maybe now the Federal Reserve needs to think about interest rate cuts? You know, unfortunately, I don't think they're there yet because we're still discussing if they're going to do 25 or not. You know, but certainly, if history is a guide, at least, you know, when they do get to the top of a rate hiking cycle and they pause, you know, usually the next move is down.
Tiffany, if credit conditions are so tight, why are we not seeing it in the data? Why is it not percolating through to a lost momentum? Why am I getting letters from people saying you clearly haven't been out, and seeing everybody eating out and flying around and doing things and getting jobs? So where's the disconnect?
Yeah, well, I think the issue here is that, again, like what's happening in the banking sector right now is a bit more of a leading indicator. We look at the actual data, you know, that's kind of what has been happening. You know, and again, you know, as I said, these things kind of happen in a nonlinear way. In other words, the economy doesn't tend to just slow down, you know, in a stable way, right? It kind of slows down, and then at some point, you know, it really starts to deteriorate. You know, and obviously, you know, that's kind of when we go into a recession. You know, so I think we've sort of been suggesting that the recession probabilities are very high as a result of how fast central banks have moved over the last year in order to get inflation down. You know, we still think that, you know, if anything, the developments in the banks over the last couple of weeks have probably pulled forward those recession probabilities somewhat.
This is what Bob Michael over at JP Morgan Asset Management was saying as well. He thinks that this brings forward the potential recession. That said, what is the risk if the Fed pauses now, starts cutting rates as soon as June, which is what the market is currently playing around with here, and more more aggressively cuts rates throughout the year, what are the risks of inflation perking back up again? That basically that momentum doesn't die out quickly enough as people start to buy homes and take out auto loans and do all the things that they can do with lower rates.
Well, so I think the issue here is that inflation is very elevated. If we were at even 3% inflation, I certainly don't think the Fed would be hiking if they do turn out to doing so this week. But the thing is when you have banking sector stress that tightens credit conditions, reduces banks' willingness to lend, you're going to have activity that's slowing down, and ultimately you're going to have inflation that's coming down. The issue, though, is that there are lags to these things. And inflation, even if we do go into a recession, over the next couple of quarters, say, it's going to take a little bit longer, even despite that, for inflation to be more clearly coming back to target. So, unfortunately, as a result of the high levels of inflation, the Federal Reserve and other central banks right now, the ECB, of course, as well, they're going to be kind of lagging in their response relative to what we've seen in the recent past. And I think the question there is, does that tighten financial conditions even more as investors get worried?
I'm a little concerned about the political implications here, and I've been raising this throughout the morning, and I'm not sure exactly how this plays out, so please help me, because I'm thinking about Silicon Valley Bank and the story in the New York Times, the stories in Bloomberg about how aware Fed regulators were about some of the issues there, the fact that there were oversights there, the fact that we don't know what other oversights there could be at other medium-sized banks that were highlighted to regulators that they're watching right now. What is the signal of not raising rates by 25 basis points if they do have a handle, as Neil Dutta pointed out, on what's going on in the financial system in a way that the rest of the market does not?
Well, that's true that the Federal Reserve has more information than market participants about banks and what's going on. And I think that the Fed basically has to weigh kind of two issues here. One is just the risk that, things deteriorate, they hike again, things deteriorate quite a bit more within the banking sector, and that sort of in and of itself kind of destabilizes confidence, because one of the issues here obviously is higher interest rates. That's what created some of the unrealized losses on these banks. There's a question around how much can banks raise their deposit rates to stem some of the capital or the deposit outflows from those institutions. So raising rates certainly is not going to help those types of things. So I think the Fed has to weigh that with the fact of kind of what you're talking about. What does it signal if they do pause? I actually think that if they did pause, Chair Powell could very easily sort of communicate in such a way that keeps confidence. He could suggest that, there's a lot of volatility in markets right now. We're just going to pause. Our outlook is still for additional rate hikes, contingent on this not getting worse. And so that would sort of suggest to markets, that, we don't think we're pausing. We don't want to, exacerbate the stress. But our outlook is still for hikes. That could potentially bridge the gap.
Just quickly, Tiffany, if the Fed does start cutting, where do they end up? What is the new normal for neutral?
I think that's still a very key question, and that's something, unfortunately, that we're not going to know, until after the fact. Right. Even the models that people have devised to estimate neutral, they need to see the data, so we don't really even know, according to the models, where neutral would be until, kind of well after where we are right now. So I think that's still a key question. Ultimately, I think our view would still be that we're in this world of new neutral, so it's still pretty low.
Tiffany Wilding of PIMCO, thank you so much for taking the time. Coming up, we have a conversation with Leon Cooperman, Chairman and CEO of Omega Family Office, to parse through the role of private investors, the understanding of markets, and how quickly we have brought forward recession risk. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Central banks worldwide are endorsing Credit Suisse's rescue after UBS agreed to buy the Swiss bank for $3.2 billion in a government-brokered deal. U.S. Treasury Secretary Janet Yellen and Fed Chair Jerome Powell welcomed the news and said that the capital and liquidity of U.S. banks is strong. Both the European Central Bank and Bank of England also endorsed the actions taken by the Swiss authorities. First Republic is set to extend its record loss today. Shares of the bank are plunging in pre-market trading after S&P Global Markets cut its credit rating again. Last week, some of the biggest U.S. banks pledged $30 billion in cash for First Republic in an attempt to stem the turmoil. Donald Trump's claim that he'll be arrested Tuesday has Republican Party leaders rallying to his side. The former president wrote on social media that he expects to be arrested as part of a New York investigation into hush money payments to an adult film star. He urged his supporters to protest. The European Union is set to agree on a plan to send Ukraine 1 million artillery rounds over the next year. Foreign and defense ministers are expected to reach an agreement today. They'll also approve spending more than $1 billion to reimburse EU members who send Ukraine shells from their own stockpiles. And Starbucks says Laxmi Narasimha has assumed the role of chief executive officer 2 weeks earlier than planned. Narasimha began working at the coffee giant in October and spent the last few months getting to know operations at more than 30 stores and other facilities. He's replacing Starbucks founder Howard Schultz, who had been interim CEO since April. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology. And welcome to Balance of Power. This is Bloomberg.
UBS's announcement of the acquisition of Credit Suisse is certainly going to should calm the fears of a global banking crisis. What I'll be watching this week is whether there are more pressures on the liquidity of mid-size and regional banks in the United States that would conceivably keep this, I'll call it a mini crisis, brewing for the next few days.
All eyes certainly are on the regional banks as well as UBS shares as people digest what happened over the weekend with UBS taking over Credit Suisse in basically a shotgun marriage operated by the Swiss authorities. That was Dennis Lockhart, former Atlanta Fed president. This is Bloomberg Surveillance. John Farrow is off preparing for his next property. Tom Keene is on a well-deserved week off. And we are taking a look at markets that are trying to find direction after all of the events, given what the concerns are about the banking industry, and given that people are trying to parse through a Fed response, which is likely less in terms of hikes and more in terms of cuts. We are seeing the S&P up about 0.2% ahead of the open. Euro strength, this is interesting after Christine Lagarde came out and raised rates by 50 basis points. Will Jay Powell also raise rates on Wednesday or not? We see that 10-year yield coming in just a touch, but really the action is in the 2-year with yields decidedly lower, down more than a percentage point from the high on March 8th. Just shocking to see 3.8% on that 2-year yield in the U.S. after it had been as high as 5.1% earlier just this month, and lower on crude. And it's kind of interesting to see this as people expect to see some sort of deterioration in the overall economy. UBS shares clawing back some of the earlier losses. At one point were lower by more than 10%, now down just fractionally, down about 0.9%, really clawing back almost to zero, almost to neutral, almost to no gains, no losses, as people think maybe they got a better deal than they otherwise thought because of the backstop from the Swiss government, because of the losses being written into the AT1 bonds, and given the fact that they're getting a U.S. business, assets under management, and the crown jewel for such a discount. Joining us now, I want to get straight to this guest because he has been calling about the potential for a recession, about irresponsible Federal Reserve policies, about how to conduct market operations in a market that has gotten a little bit beyond what we are used to thinking about with a capitalist society. Leon Cooperman, Chairman and CEO of Omega Family Office, joining us now. And Leon, I just want to first start with, what's your impression of everything that we've seen over the past, I would say, week, last weekend with what happened with Silicon Valley Bank, and just now with UBS taking over Credit Suisse?
I think, without being overly simplistic, to me, it's kind of like textbook. We've degenerated into a system of leadership at a crisis. We have a self-induced crisis by irresponsible fiscal monetary policy the last decade. I did not forecast the Silicon Bank issue, but I did have a view that we were heading to a crisis of some kind, and we've seen it. And we're getting a predictable response by government. And so I think it's sad, what's going on in the country, but what they're doing is what is necessary to be done. They have to preserve the system. So I'm assuming that the Fed goes 25 bips on Wednesday, 25 and done. They can accept a higher level of inflation and than they would like to accept because of the stress in the financial system. They have to stabilize the Treasury market. The volatility of bonds is so great that that's destabilizing the equities.
Well, Leon, I want to pick up on that because we've been talking about that. We've seen unbelievable fluctuations in the basic, most liquid instruments in the world, right? Treasuries. What's the read-through effect of just even that volatility on other risk assets, and how much further does it have to take that out in terms of the volatility pressuring equity valuations?
That's not my area of expertise, but I would say that this is a response to the debt buildup in the country. In 2017, we had $20 trillion of national debt. And today, we're knocking the door of $32 trillion 5 years later, 5 or 6 years later. It's just a growth rate in debt far in excess of the growth rate of the economy, which is going to create issues. Who's the buyer? The banks are not the buyer of bonds anymore. So you're relying upon the kindness of strangers, and they're probably not imbued with our financial policy. When they look at the politics of the country, it's also very depressing. We have a country that I think is largely centrist in nature. It's been taken over by two political parties with the radicals, radical right, radical left, ruling the day. We don't need this.
Well, Leon, we're dealing with a situation where the political overlay is raising questions about the debt ceiling debate, and we can get into that, and people are trying to figure out what that means economically and for the market. Your expertise is in the S&P, in the market, and market calls, and you've been warning about a recession for a long time. You've been saying that this is a self-induced error of monetary policy and woes, and I'm curious, first of all, whether you're getting more optimistic about returns because of the declines that we're seeing and because of perhaps people waking up to the reality of the potential for recession as you've been saying it.
Well, my view has been as follows. I tell the story about the Pharaoh. I told this almost a year ago on TV. The Pharaoh, had a dream. The dream was interpreted by Joseph. It was in the Bible. His dream was we're heading for 7 lean years after 7 fat years. And that is my view. I think the 4,800 on the S&P will be a high that will stand for quite some time. And then I kind of analogize that to my own career. I got my MBA from Columbia Business School on January 31st of 1967. Had a 6-month-old child at the time. Now he's a healthy 56-year-old. I had no money in the bank. Had a student loan to repay. They were not forgiving student loans. And I couldn't afford a vacation. I went to work the very next day. I joined Goldman Sachs in my 25-year career on February 1st of 67. The Dow was 1,000. In 1982 it was 1,000. And so I made my money picking stocks. You know, I'm not selling anything to anybody because I'm a retired money manager and I'm turning 80 years old in a few weeks. But I would say that I think we're in a stock picker's environment. I expect the returns in the S&P to be very pedestrian. I think what's going on in the world is negative for price earnings ratios. And I want to make this point. If the government is looked upon to moderate the downside risk, the government has every right to moderate the upside return. Okay, this CHIPS Act, you know, I think Intel sits in a balance sheet of $50 billion. They don't need the government to build plants for them. They can do it themselves. I'm in favor of private sector solutions. And the extent that the political system is getting corrupted, that's negative for capitalism long term.
So, Leon, from your perspective, you have made your career in picking single stocks. Where are you putting your money now, given that you still are investing, if perhaps for yourself and for others? Where do you go?
I'm like a one-off kind of guy. I'm looking at a couple of these mortgage REITs that are yielding 14 to 16%, selling a discount to book value, where they're buying back their own stock whenever it's, in their view, cheap. But, you know, those are one-off. My biggest exposure has been energy, and that's cost me some money this year. I'm generally of the view that world travel will come back, which will be a plus for energy demand. China coming out of lockdown would be a plus for energy demand. We're going to no longer deplete the strategic petroleum reserve. We have to rebuild it. And we're not replacing reserves to the extent that we should be in terms of where we're producing.
Yeah.
Well, I have a bunch of oil stocks in my portfolio that have current yields of 5 or 10%, production cost well below current prices.
Yeah.
They're largely debt-free, and they're positioned to buy back undervalued stock. You know, so my favorite is Paramount Resources up in Canada, POU. You know, they produce oil for $31 a barrel. They're growing production at 15%. The stock yields over 5%.
Yeah.
And there's no debt.
Leon, bumping up against the clock, 30 seconds. Do you agree with Elizabeth Warren that there should be insurance for deposits that's more than $250,000 and that banks should have to pay for that?
There's very little that Elizabeth Warren says that I agree with. But, you know, I think we have to do whatever we have to do to stabilize the system, and we will do it. But I think I'm focused on the long-term implications of what they're doing. So I think that, yes, they should do whatever they got to do to stabilize the system. It's a damn shame that we have to do what we're doing, that we not should have been in this problem. You know, Mr. Powell, you know, the Fed head said that the stock market wasn't overvalued. This is a few years ago because of where interest rates were. He never bothered telling people interest rates didn't belong where they were.
Leon Cooperman, we're going to have to leave it there. Thank you so much for joining us. Leon Cooperman of Omega Family Office. We really appreciate your time. Right now, you're seeing UBS shares, at least the ADRs, clawing back all losses in pre-market trading as people reassess this deal. Coming up on Bloomberg Television at 3:30 p.m., Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley, from New York on a day parsing through the uncertainty. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
It feels like last week never ended. Live from New York City this morning. Good morning, good morning. Equity futures positive 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, UBS agreeing to take over Credit Suisse for $3 billion. First Republic slides following another downgrade, leaving Chair Powell to confront a difficult decision. We begin with the big issue, a major takeover and a lot of questions.
This was not the best solution.
You could sit there and say, in theory, this shouldn't have happened.
But it dominated the other two, which was either nationalization or trying to wind down the bank.
Whether there are more pressures on the liquidity of mid-size and regional banks.
This has a tendency of taking a life on its own.
The system is very fragile.
The banking sector is really, it runs on confidence.
And right now the markets are hunting.
I'll call it a mini crisis brewing.
Whether it's rational or not doesn't really matter.
People are doing something that probably is not rational.
And that is where we're at right now.
Whether the Fed tightens or not.
For sure it's going to slow growth. For sure it's going to bring down inflationary pressures.
Financial conditions will tighten from here.
I'm anxious to see what the Fed does on Wednesday.
Team coverage begins right now with Bloomberg's Manus Cranney in Zurich alongside Kelly Lyons down in DC. Manus, first to you. UBS has gone from negative 16% to positive 1%. Make sense of it for us.
This is really hard to do because there was a whiff of panic right the way across the equity markets and the bond markets, the AT1. This is the issue, Jonathan. A lot of people were trying to rationalize. They've got a backstop. They've got the liquidity. They've got the government backstop for $9 billion. If there's anything really toxic or takes a long time to run off the CS book. But this was a very unique Swiss solution to a Swiss problem, creating a behemoth, and then the market convulsed. Because what they did here in Switzerland was they inverted the capital structure. They bailed in the bonds without wiping out the equity. So the risk here, Jonathan, is that maybe UBS has got their hands on a crown jewel, and we're just through the shock, but I don't think we're done with the awe.
Well, Manus, let's talk about the rest of Europe. Have the European regulator taken what Credit Suisse and UBS got up to yesterday?
EBA, European Banking Authority, came out and went, excuse me, In Switzerland, they are bailing in the AT1 bonds. Please refer to the other side of the border. Over here in Europe, over there, Deutsche Bank, SocGen, Paribas, core equity tier 1 gets toasted first, not AT1. And therein lies the differential. That is what you had, Jonathan. You had, I think, a very political solution, which was bailing in the bonds and not the equity. Shareholders around here, pensioners around here in Switzerland own UBS. They own Credit Suisse. This was a political decision to bail in the bonds, and maybe more politics than finance. But that's my personal take, and not written by any weighty authors of Wall Street or of Lombard Street.
Well, you're not alone. I'm hearing the same thing. Just echoes of that over the last 24 hours or so. So UBS turning positive, up 1% at the moment. Elsewhere in Europe, ING down 2.8%, SocGen down 1.8%, Deutsche Bank down 1.7%. No real drama there. You want drama? First Republic down almost 19% in pre-market trading. Katie Lyons going into the opening bout following another downgrade.
Yeah, another downgrade and looking set for another at least start to the week of losses. Remember, this 19% decline in pre-market trading this morning comes after an 81% decline already over the last 2 weeks. What is noteworthy, though, is this is First Republic specific. Other regional banks like PacWest or Western Alliance are actually rallying today. But of course, as you say, John, the reason First Republic is under this pressure is because of the second ratings downgrade from S&P in less than a week, cut to B+ from double B+ last Wednesday. The rating agency saying that $30 billion in deposits from 11 large banks is not a longer-term solution to this bank's funding issues. They say attracting meaningful deposits will be difficult, and it is certainly difficult for the stock this morning, John.
Kelly, we'll catch up with you in about 10 minutes again to go through some of these issues. Managed tremendous coverage together with Francine in the last 24 hours. Just absolutely brilliant. UBS turning positive, then up 0.7%. The stock was down by something like 16% earlier on in the session. Equity futures on the S&P just about positive as well, up 0.2%. Joining us now to discuss is BlackRock's Gargi Chowdhury, Mona Mahajan of Edward Jones. Mona, first to you, and to the both of you, thanks for being with us. Let's start here. Have we found a solution, Mona, or is this just a sticking plaster?
Yeah, you know what? Look, I think we have to get through two big hurdles this week. First, of course, is what will happen to First Republic. And it's interesting to see what the Swiss National Bank and the Swiss government mandated essentially with UBS and Credit Suisse. First Republic has to find a solution here as well, has to find some footing. And clearly, the 11 large banks stepping in with a $30 billion aid package was not enough. So that's the first hurdle. The second one, of course, we're facing a big Fed meeting this week, and there is an opportunity there, we think, for the Fed to step in and really add a bit of confidence to this situation. Of course, they've already started to work with global central banks, providing a little bit more liquidity for their dollar swaps program, but we could really hear from the Fed about what they may do as the lender of last resort. Now, keep in mind, of course, they are also facing an interest rate decision this week. We do think that they will, the market is giving them 25 basis points, take it, similar to the ECB, but they'll also provide very strong messaging around what they will do in case the situation gets worse. Now, the final message I'll leave you with is that we do think that this is very different than the situation we saw back in 2008. And of course, it might be evoking memories of the financial crisis, but of course, large banks here in the US are better capitalized. They have more diversified revenue streams. They are more regulated, and balance sheets are looking much better. So very different situation, we think, not necessarily as a systemic a risk that we saw back then. So a better situation broadly, but we need to see some backstops in place in the weeks ahead.
But still, if we're spending Sunday evenings waiting for solutions to banking problems, you know we're not in a good place, aren't we? That's where we were again yesterday. First Republic on Friday. 11 banks put together 30 billion, deposited in First Republic, and still that drops 33%. In the pre-market, it's down about 19% right now. Gargi, a wise Italian at the ECB, a long time ago turned around and said he'll do whatever it takes. And I just wonder what it would take to stabilize things.
Good morning, John. It's great to be here. Thank you for having me. So I think, first of all, a little bit of time. I think this is just the beginning in terms of us beginning to figure out the broader ramifications of everything that we've learned over the last 10 days. So, for example, this is just the beginning of us trying to make sense of this, how systemic this can get. I think there is more pain to be felt for regional and smaller banks, for sure. I think that's also going to lend itself to lower credit growth in the economy. which of course is then going to mean that there's going to be slower growth in the US economy for the quarters ahead. So while we've obviously had some good news, especially it's been incredible to see the rapid response that the Fed has been able to generate so far. Last weekend, overnight, the news on the currency swaps, I still think it's too early for us to say that the bottom of the equity market is here, because we're still going to get a lot more regulatory changes, especially in the banking system.
So Goldman say pause. They say this: we expect the FOMC to pause at its March meeting this week because of stress in the banking system. Mona, what do you say?
Yeah, you know, it's interesting. I noted earlier, markets are pricing in still a 70% probability of a 25 basis point rate hike. We think the Fed may follow what the ECB did last week, which, you know, in fact, they raised 50 basis points. We think the Fed may take a 25 basis point rate hike this week and then pause at that point. And look, the next meeting is not till May. There's a lot that can happen between now and May. And, you know, to Gargi's point, we do think also some of the broader market and macro implications of this banking crisis is you could have a consumer that is marginally spending less, which puts less pressure on the services sector of inflation, which is what we really need to see cooling. And over time could create, you know, the situation or the scenario where a Fed could pause earlier than anticipated. So to some extent, there are implications that the economy could be going through this cycle faster than we originally thought. But we do think generally the Fed will take the opportunity to do the 25 basis point rate hike, and then we'll wait and see what happens after that.
Gargi, you on the same page?
So I think the Fed has to do what we all did this weekend: compartmentalize, compartmentalize, compartmentalize. So think about telling the market about the policy toolkit that they have in hand to deal with inflation, right? So inflation still, we saw this past week, 0.45% on core. That's a very strong number. And the policy tools, such as raising rates by 25 basis points, which is my expectation, is a very good tool for that. But on the other side, they also have liquidity tools, which are not the monetary policy tools. So differentiating between the tools they have for fighting inflation and the tools they have for supporting the liquidity situation in the banking system are different. And I think Chair Powell will get an A+ if he's able to communicate that, just like Christine Lagarde did. So yes, I do think they are going to raise 25 basis points, and they should. And at the same time, to Mona's point, I think this might mean a lower, higher for longer. So if you were sitting and thinking that we might need to go to 6%, perhaps we've, you know, brought that down a little bit. But inflation is still here. They haven't won that battle yet. So this week is definitely a go on 25 basis points. What I think is much more important, or what I'll be focusing on, is how they are guiding us to the years ahead, and even for their terminal Fed funds rate. So are they going to move their dots a little bit higher for the remainder of 2023? I think that's a tougher call. I still think they will move that higher for 2023, and then, you know, sort of show a decline in rates for 2024 and 2025, and neutral probably remains unchanged.
I've got no idea how you put together any kind of forecast beyond next week. No idea whatsoever. Citi's trying to do it.
But they have to.
Andrew Hollenhorst is trying to do it as well. They say the FOMC will hike 25, 475 to 5, raise the 23.25 to 525 to 550. I remember back in the pandemic when they binned the SCP, threw it in the trash, and didn't bother publishing one. I'm not saying they're going to do that this time around, just saying it might be an option if they're all totally clueless. You said something interesting, Gargi, a few things actually, as always. You mentioned compartmentalize. I just wonder whether policy is truly in conflict. Given what's happening in the banking situation right now, a lot of people just think that's going to lead naturally now, inevitably, to tighter lending standards and tighter financial conditions. Won't that just do the work for them?
I think it will, but it'll take some time. And in that time, inflation is still at 5.5%. So to my second point that I had made earlier around rates are still going to stay high, but perhaps not as high as we had thought the beginning of March. So I do think that they are very cognizant that the credit channel will slow down the economy. And I do believe that we'll probably see a recession earlier than we'd perhaps previously thought because of the impact of tightening credit conditions and because of smaller and regional sized banks cutting back lending to commercial real estate, to residential real estate, to consumers. And all of that's going to have an impact on growth. But I don't think that the inherent problem of inflation being at 5.5%, inflation projecting, I think they'll project to inflation being at about 3.5 or 3.6% by the end of this year. And I don't think that problem is solved if they pause right here, right now. So go the 25, wait and watch what happens, and at the same time, make sure that we investors know that there's a lot of liquidity provisions at play if there's further systemic issues that evolve from here on in the banking system.
Gagi, where does that leave your call on treasuries? Bonds are working. Bonds are working because of the changing nature of risk away from inflation to the dominant concerns of the last few weeks. Do they continue to work?
I think I was at this show when I talked about yield of dreams and bonds are back, and I think bonds are still back, but you want to be staying very much in the front end of the curve. And when I look at what's been transpiring, what investors have been doing, they've been allocating to front end ETFs like SHV and SGOV because they want to make sure that they're earning these incredible yields, but not taking too much duration risk because you don't need to. The curve is so inverted. So stay in treasuries, stay in high quality treasuries in the front end of the curve, earn that coupon, earn that yield. And actually, we're changing our call a little bit. My team and iShares Investment Strategy, we're changing our call on where you want to be in the equity markets. We had previously thought that you were supposed to be in the value sectors, but now we're changing that call and telling investors that quality, so the quality of your balance sheets are going to make the most difference now. So gravitate to quality and gravitate to minimum volatility. Don't be a hero here. Have sort of lower risk, but when you have the risk, have it in fixed income front end, have it in quality companies, and stay lower volatility.
Gagi, wonderful to see you, as always. I know you've got to run. Gagi Chowdhury there. Mona Mahajan's going to be sticking with us to work through some of these issues. Thank you. Equity futures positive 0.4% on the S&P 500. Let's get you some stocks on the move ahead of the opening bell. Is Abby.
Well, John, let's start with and stick with where the drama is. And this is, of course, Credit Suisse and UBS. Credit Suisse, the ADR absolutely plunging, trading below $1 following shares in Europe, down 55% in the pre-market. Simply stunning. UBS, on the other hand, as you all have been talking about, reversing its as much as 16% plunge earlier. All of this as UBS is coming in with that $3 billion bid, highly politicized, as Manus Cranny was talking about. So big trading action there. But we're not having a lack of drama here in the U.S. either, as you were talking about earlier with Kaylee. We have the shares of First Republic plunging once again, now down more than 80% since the Silicon Valley bank crisis was unveiled. This is as S&P cuts First Republic's rating once again deeper into junk territory, warning that the $30 billion rescue certainly doesn't solve everything for First Republic. On the other hand, PacWest, a bit of a recovery, up 17%, and then New York Community Bank Corp soaring up 34% as they are said to pursue a deal to buy Signature Bank here in New York. John.
Abby, thanks for that. Much more from Abby around the opening bell. Coming up, another downgrade weighing on First Republic.
The company has made incredible profits over the years. Its credit quality is superb, but they have the mismatch on the assets versus the liabilities, which is what everybody's concerned about. We need to see where those deposit levels are.
That conversation up next.
Did Art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
They have focused very successfully on the large high net worth depositor. And those depositors, as we've seen with the other banks that have seen deposit flight, have been moving out. So we need to see some first quarter results. I know that's not that close. We need to see where those deposit levels are. Its credit quality is superb, but they have the mismatch on the assets versus the liabilities, which is what everybody's concerned about.
I'm beyond jealous of Gerald Cassidy's house, but that's a story for another day. First Republic under pressure. Last week, 11 banks coming together to the tune of $30 billion in deposits, trying to restore confidence in the name. The losses just kept piling up. The bank hit with another downgrade over the weekend. Here's the line from S&P. We do not view this deposit infusion as a longer-term solution to the bank's funding issues. Attracting meaningful deposits will be difficult. From Washington, Bloomberg's Katie Lyons is back with us with more. Hi, Kaylee.
Hey, John, and difficult it has been for shareholders in this name because once again, after a 33% loss in the Friday session, after that announcement of the $30 billion in deposits infused into this bank by the larger banks, we once again are seeing the stock down 18% again this morning after, of course, this second downgrade by S&P Global Ratings. This just is continuing the pattern of First Republic underperforming other regional banks, the likes of Western Alliance, PacWest actually rallying today. And over the course of the last 2 weeks, which, yes, has been rough for regional banks broadly, they're down about 27.5% over that time. First Republic down 81%. Its losses have been far greater. And this is because this is a bank that is seen as having higher concentration risk among its depositor base, similar to what we saw with Silicon Valley Bank and Signature, which of course are the two banks that have failed. So it raises a question of what the future of this bank may be. Does it need to be bought? Could we see it put into receivership? These are the kind of questions we are asking. All of that said, this may be seen as a idiosyncratic story rather than one of broader systemic risk, because if you take a look at their 2046 bond yield, 8%, yes, it has spiked dramatically over the course of the last several weeks. Still, though, that is far from distressed territory. So the credit market may be telling you that this is not contagion risk, at least at this point, John.
Katie, thanks for that. Mona Mahajan back with us for a final thought. Mona, that word, idiosyncratic. So last week, SVB, we were told it was idiosyncratic. Signature Bank, the same thing. Credit Suisse, problems for years. Do you take note of that, or do you see a much broader, bigger problem here?
Yeah, look, I think right now markets are worried about the unknowns and what they really don't have their hands around. And so I think, first of all, we have to be a little bit cautious in the weeks ahead. We have to see the fallout, not only from what could happen with Credit Suisse and UBS, but what's happening with the regional banking system here in the U.S. I would take note that this week's Fed meeting, as we noted earlier, could be really clarifying in that Jerome Powell has the opportunity to step up and talk about how the Fed can be this lender of last resort, how they can provide a little bit of liquidity and a backstop to the regional banking system. Overall, we do think that when all is said and done over time, these should become, or these will probably be idiosyncratic stories and not become systemic issues. But only time will tell, and I think in the interim there will be volatility. Some of the defensive posturing we're seeing in the markets we think could persist in the near term, but over time we think the economy will go through a downturn and recovery process, and the opportunities that are forming could be interesting both in the equity space and the bond space. So sit tight for now. That defensive posturing near term makes sense, but over time think about the opportunities.
What are the opportunities in equities right now?
So, right now we think what's been performing better have been the parts of the market that are traditionally defensive, recession-proof sectors like healthcare and consumer staples. Interestingly, quality growth parts of the market have been holding up as well. So areas of technology, parts of discretionary as well. We think those are really where you can hide out for now. Gargi had mentioned the short end of the curve. That's been working as well. Over time, when the economy does go through a bottoming and recovery process, markets will look ahead to a recovery playbook. We started to get that a little early this year, but areas like small caps, like your more cyclical parts of the market, like international markets, those are the things you want to keep in mind as the opportunities, probably more towards the 6 to 12 months ahead. So we think near term defensive, short end of the curve, as well as your defensive and quality growth parts of the market, but longer term, think about your recovery playbook.
The script has flipped, I think, about 3 or 4 times, and we're not even through the whole of Q1. Mona Mahajan, Mona, thank you, as always. Equity futures right now positive, a little more than 0.1%. Coming up in the morning calls and later, breaking down the banks with Baird's David George, and Daryl Cronk of Wells Fargo on why he thinks stocks have further to fall. That conversation coming up shortly.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Could face bigger challenges next.
Was going to keep rain World Cup. This is a 3.
As the economic picture does.
Is it the OK is getting ready to make a decision?
Or 5 minutes away from the opening bow. Futures pushing on, up 0.2%. Let's get you some morning calls. First up, Bernstein upgrading Pepsi to market perform, citing signs of improvement after delivering strong growth relative to peers. Raymond James raising its price target for Intel to 33. The analyst saying the worst is behind for the chip sector. And finally, KBW downgrading UBS to underperform, highlighting considerable uncertainty around its earnings trajectory. That stock just turning positive in the last hour by 3%. Coming up, David George of Baird on the banks and Daryl Cronk of Wells Fargo on why he sees further downside for equities.
Chinese technology companies, let's say Alibaba, Baidu, Tencent. They have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
With all the banking turmoil, easy to forget that we're actually coming off the back of a week of gains on the S&P 500. On the NASDAQ as well, on the S&P, futures pushing on by 0.2%. The NASDAQ 100 last week up almost 6%. This morning, negative about 0.2%. That's the opening bell. Switch at the board and get to the bond market. Another rally in treasuries. Yield to lower by a couple of basis points on a 10-year, 340. A handful of basis points on a 2-year through much of this morning. On a 2-year right now in America, your yield comes in a couple of basis points on a 2-year right now, 381. That's where euro dollar positive 0.5%, 107.22 to about 107. Off the back of the moves we've seen from the Swiss authorities overnight. UBS positive by 3%. I'll come back to that story later. And crude down again by 0.7% to 66.29. About 30 seconds into the session, your equity market opens higher, positive on the S&P by a little more than 0.1%. One stock to watch at the open is First Republic. Shares extending record losses as the bank gets its second downgrade in a week. For more, Bloomberg's Kelly Lyons has more. Hey, Kelly.
Hey, John, yeah, more pain for First Republic this morning. Right now at the opening bell, the stock down by about 19% after S&P Global Ratings cut the credit rating to B+ from double B+, which it was just cut to last Wednesday. The rating agency saying that the $30 billion in deposits it received from 11 larger banks last week in the form of an attempted, I say, rescue is not going to be a longer-term solution to this bank's funding troubles. They think it is going to have significant difficulty attracting deposits. This is the plight of regional banks in this moment after we saw the failures of Silicon Valley Bank and Signature Bank. So the question for First Republic is, where does it go next? Does it have to have another form of rescue, potentially a deal? Our reporting here at Bloomberg, our understanding is that Tom Barrack, which is a member of First Republic's board, is playing a key role in talks to save it. In what form that savior comes, though, that is still an open question. Meanwhile, the pressure on the stock is continuing. The losses today add on to 81% declines over the last 2 weeks. This was a $122 stock 2 Mondays ago, John. On this Monday morning, it is trading at $19 a share.
Said the same thing a couple of times in the last 24 hours. Remarkable. Kaylee, thank you. Thank you for that. Elsewhere in the regionals, some big moves in the other direction. Abby has more. Hey, Abby.
Hey, John. Yeah, it's really pretty incredible because despite those continued woes for First Republic, we do have the regionals really putting together a rally today here on the morning. The KRE, that regional banking ETF, up more than 1%. And Western Alliance is really popping. B of A saying that their deposit trends appear to be stabilizing. So that's good news. And New York Community Bank Corp, that stock is up 36%. On the open, it had been up 40%. A record open in for that regional bank on the possibility that they are going to buy Signature Bank. You typically don't see the acquiring stock going up so much, but perhaps that's a proxy for Signature Bank since it was shuttered. Now, relative to the bigger banks, they are also rallying on the day. That's why we have this KBW Bank Index, which is a bit of a blend between the big banks, the money center banks such as JP Morgan, B of A, Citigroup, up 23%, being helped just a little bit this morning with those big banks up at this point up about 2% or so. The volatility, though, John, it's likely to stick around, but something important to remember, it could be to the upside or the downside. What we're looking at here in the top panel is the KRE and its implied volatility on a 10-day basis in yellow, popping sky high. Relative to the bottom panel, it's the same deal, but for the BKX. You can see that for the BKX, or that KBW Bank Index, that blended bank index, volatility flattening out, but for the regional banks, it's still going higher. But again, volatility can go back in both directions, so today we're seeing a bit of a mixture there.
Abby, thanks for that. Staying on top of the bank moves. We were staying on top of the bank moves for the whole weekend. The drama around Credit Suisse, UBS finally sealing a deal for around $3 billion. You might have been spooked if you woke up early this morning as a shareholder of UBS, down 16% at one point, positive almost 4.6% right now. Shanali Basak has more. Hey, Shanali.
John, you have to think about the coordinated responses you saw after the deal was announced. There are a lot of worries about UBS taking on this massive bank. However, you do have those assurances from the Swiss Central Bank that make it a little bit easier. It turns out every 10 to 15 years as we keep going through this, it gets easier for the central banks to respond. Now, I want to actually talk really quickly here about the COCOs here, the AT1 securities, because that's where a lot of the infighting was. The fact that they were wiped out, the fact here that the ECB has come out and said that common equity holders are really the first in line here to bear losses, stems some of the pains in the market that we saw. Investors are starting to think a little bit long term, but remember, there is a lot of pain still under the surface. Other banks are still across Europe facing some downward pressure in their stocks, bonds as well. It is early days yet as we think about what this deal means for global markets.
The Bank of England's had to come out and address the same issue literally in the last couple of minutes. Shanali, what's changed for you after this weekend?
Counterparty risk. You have to think about the last couple of weeks and just how much pain the hedge fund community and the subsequent trading desks that banks have already felt. Banks have limits, John, on credit lines that can be extended to every client. Credit is tightening up with one globally systemic bank out of the picture here. There were a lot of people who stuck with Credit Suisse to make sure that they could still kind of have some firepower here. There are ripple effects that are beyond the obvious that will take some time to see how they'll feed into the market.
UBS up 5% right now. Shanali, tremendous work as always. Thank you. Dan Iverson of PIMCO said it to us last week. Multi-month process. Not a couple of days, not a one-weekend solution. Got to work through a multi-month process here. I'm pleased to say that joining us now is David George of Baird, a constructive voice on the regionals. David, wonderful to catch up with you again, and thanks for being with us. You say regional banks offer the best risk-reward in years. Walk me through why, David.
Well, it's good morning, John. Hope you had a great weekend. Great to be on. We think that this is the best setup that we've seen since the financial crisis for the bank stock group. And the financial crisis was an actual crisis. This, in our view, is not a crisis. This is a couple of select institutions with very non-granular deposit bases, which really is the antithesis of most of the major banks that have very granular funding, very sticky funding. And I think over time, as the dust settles, the quality of these deposit franchises, especially for the larger regional banks, are going to shine through, and I think is resulting in an epic opportunity on the long side.
David, if it is so idiosyncratic, why are mid-sized banks over the weekend asking the FDIC to insure all deposits for 2 years? Do you get the sense that maybe it might be worse?
It certainly could be. Look, there's a lot of panic, and when you see $40 billion move out of a bank in a day, it gets people's attention. And I'm sure there are a lot of clients are calling their banks thinking about what should they be doing with their liquidity. And I think a raising of the limit would probably stem some of that. So it's not particularly surprising. It wouldn't surprise me to see the FDIC take the limits up. But again, we're just in a period with a lot of panic, and we're trying to keep our heads cool and just look at the stocks and look at the valuations. And they really have not been more compelling than they are today, in our opinion.
Senator Warren was talking about 1 million, 2 million, 3 million. Do you have a number in mind, David, on what really addresses the issue?
it's a dangerous game to get into. I think 500 to $1 million would be a reasonable start and would probably stem a lot of these fears. Keep in mind, many commercial borrowers, as part of their contractual relationship with their bank, actually have to keep their operating accounts with their bank. So I just don't think when we see bank earnings in a month, I just am not expecting meaningful deposit movement. We've seen a lot of deposit movement out of banks into higher yielding products over the last year or so, and I think that's ongoing and will continue. But I think when we see these results, this panic that everyone is worried about, I just don't expect that.
David, I don't know if you can speak directly to First Republic, but just to raise what's happening right now, we're down about 14%. You saw the move last week, 11 banks come together, 30 billion in deposit into the institution. Not enough to address it on Friday, down more than 30%. This phrase that got thrown around in Yellen's testimony last week, Secretary Yellen's testimony, a two-tier banking system. I think the public are latching onto that phrase, David. Do you see it as a two-tier banking system?
I can see where people, and I don't cover First Republic, so I can't talk about the stock. Sure. But I do see. I can see where that. I watch some of the Sunday shows, and unfortunately, I think a lot of the logic is flawed. Where First Republic is a little different. Again, I think a lot of this, John, revolves around granularity of funding. In other words, what is the average account size for a bank? In Silicon Valley, it was over 4 million. And I think First Republic's case, I think it's close to 1 million. For most banks, it's in the 50 to 100,000 range. So just a meaningful difference in funding. And I think that is really the big differentiating factor when you're thinking about the bank group broadly. And I just think that these issues, again, the idiosyncratic word has been thrown around a lot, but I think when this all kind of settles down, it's going to prove that these were really one-off situations that were not funded in a similar way that most banks are.
Well, David, appreciate your perspective, as always. Managed to catch up with you the last couple of weeks and looking forward to doing the same over the following few weeks as well. The S&P 500 just about positive by, let's call it, 0.25%. Daryl Cronk of Wells Fargo has this to say: it's still not a time to broadly buy equities. In the wake of current bank fallout, financial markets need more time to adjust to the reality of a weakening economy. There is likely more downside risk in stocks at this point. I'm pleased to say that Daryl joins us right now. Daryl, I'm sure you had the chance to listen to David George there, a much more constructive view on what's happening with banks. Where do you come down on this?
Yeah, good morning, John. So I still think the fundamentals don't line up and the technicals don't line up. We've talked about this on your show a couple times before. If you look at, you've only got less than a quarter of names in the S&P 500 above their 20-day, above their 50-day. We're at a lower percentage above the 200-day than we were back at the December lows when the indice was around 3750. So this is an old-fashioned gunfight at the OK Corral right now between the bulls and the bears. And the bulls are looking at it from cash-rich, balance sheets, things like technology, discretionary, and some of the comm services. And the bears latched on to, of course, banks and financials, energy, REITs, and healthcare right now. And they're both fighting it out very hard to see who's going to win. We're still below the 200-day moving average. That's, as I said in my notes, that's where accidents happen typically. So I think the preponderance of evidence still suggests there's probably more downside here than upside.
Daryl, at the end of the day, I don't think this comes down to what I think you think. David George was on moments ago giving a really constructive view of things. There's an analyst really in the weeds, knows his numbers. I'm not sure the public sees it that way, Daryl. They're not looking at it at that level. They're just saying, okay, what's the name of my bank? Is that systemically important? I'm not sure. I'm going to open an account with B of A, JP Morgan, Citi, take your pick. Daryl, how do we resolve that?
Yeah, I think, look, we've jolted depositors here, right? And injured their psyche a little bit. And so they're going to naturally react to that. And we're seeing it in some of the flow and everything else. So I think that will settle down, to be honest, John, at some point. I don't disagree with the prior speaker saying, look, this is a little bit, when you get into banking crises, they're almost always about confidence and liquidity and maybe less about valuation and asset levels. That's true of today's level. I do think what I called this was a little bit of an echo crisis, which tends to be a rolling echo from one epicenter to the next, right? We've seen it from some of the banks into the global banks. I think there's another role here. I think people, when you look at the CFTC data on short positions on the 2-year Treasury that people scrambled like crazy last week to cover, and you had a 13 standard deviation move in the U.S. Treasury 2-year note, which should never happen statistically. There's some people that got hurt by that, right?
Yeah.
And I don't think that news is out there yet.
It's a massive move. Let's be clear about that. The 2-year was north of 5%. It's comfortably south of 4 now at 386.
That's right.
One place, Darryl, we've seen real outperformance off the back of that move in the bond market is the NASDAQ. Do you think mega cap tech is immune to the difficulties that we're discussing?
No, I don't think it's immune, but you go back to that fight again. What you've seen is not just mega cap tech, John, but you've seen a flight to quality here lately. I mean, bonds have rallied, gold has rallied. Some would call cryptocurrencies as a flight to quality rally or away from kind of the traditional risk and the epicenter of where it is. And you've seen those cash-rich balance sheets, particularly in the tech sector, really be a place that people perceive as a place to hide. I think they are in the near term, and we actually like tech. We've been favorable on tech for some time, and we like what's happened year to date. I mean, most people don't realize the tech sector is up 11, 12% year to date, besting the S&P by over 1,000 basis points. So there's big moves that are happening there, but I don't know that I'd call them immune, because I think that would be a faulty statement.
Darryl, wonderful to get your thoughts. What a weekend. Let's just hope we're not doing that this coming weekend again. Darryl Cronk there on the latest. I think we all suspect maybe we might be, and we're all hoping we won't be. Equities right now up 0.2% on the S&P. On the NASDAQ, we're down about 0.5%. Coming up, Senator Warren playing the blame game.
Jerome Powell just literally took a flamethrower to these regulations in order to make them less and less effective.
That conversation up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Federal Reserve Bank and Jerome Powell are ultimately responsible for the oversight and supervision of these banks. Jerome Powell has said that all he wants to do is lighten regulations on the banks. I opposed him as chairman of the Federal Reserve Bank precisely for that reason. Jerome Powell just literally took a flamethrower to these regulations in order to make them less and less effective.
I'm not sure Jerome Powell actually said that, but that's a conversation for another day, perhaps if Senator Warren comes on this program again. Senator Warren pointing the finger at the Fed chairman amid turmoil across the banking sector. This coming as Powell prepares to deliver the Fed's next decision on Wednesday. With us, AMH down in Washington, Mike McKee here in New York. Anne-Marie, I imagine you're not surprised by how this has played out over the weekend.
No, absolutely not, especially from the likes of Senator Elizabeth Warren. Remember, she opposed Powell's renomination. She called him a dangerous man during that hearing in September 2021. And now she is really pointing the blame at the Fed, and not just Jerome Powell. On Face the Nation, she was also asked about if she has confidence in Mary Daly, the head of the San Francisco Fed, and she said she doesn't. The other conversation from Elizabeth Warren, the senator of Massachusetts, over the weekend, Jonathan, was how she said that she would be in favor of lifting this FDIC insurance threshold. The question's as to how high. And the backdrop to that conversation is the fact that you have a coalition of these mid-sized banks asking regulators to do just that, lift that insurance threshold for the next 2 years, because they say this would stabilize some of this exodus, the deposits they're having out of these small regional banks into the bigger banks. But so far, Jonathan, right now, this is just a debate.
I can hear the sound of silence coming from behind you, the White House. Anne-Marie, where are they on this?
Well, it was interesting because over the weekend there was one statement from the Treasury and the Fed, and that statement had 3 sentences, just that they were working with their international partners. Of course, this has to do with what happened in Zurich regarding UBS's takeover of Credit Suisse, and that the fact that they say that the banking situation in America, that they see that the U.S. has a resolute banking situation. So a very small statement. What we do know from behind the scenes and reporting by my colleagues over the weekend is that actually last week you had Jamie Dimon sitting down with Treasury Secretary Janet Yellen. This weekend, it was potentially more calls with Warren Buffett. This is one individual that could potentially get involved in shoring up some of these regional mid-sized banks, but also just looking to him for his knowledge and expertise and experience he's had with the banking situation. But nothing out publicly, Jonathan. All these conversations are happening behind closed doors.
Mike McKee, the Fed under the spotlight this week for more reasons than one.
Well, I'm not sure about whether he's paying any attention to the political carping in Washington, because that goes with the job. But he has to worry about what's going on in the markets, and he has to worry about what's going on, even more than that, with American business. There is a new pessimism out there, and it's come from many of the people that you have been interviewing all today and yesterday. The story goes like this. Cumulative rate increases are going to choke off demand anyway. Smaller banks are now going to raise deposit rates to keep business. That will lead to tighter lending standards, and the flow of credit will slow significantly, and that's why we get a recession. Well, we'll keep an eye on it, but right now, that doesn't seem to be the actuality. If you look at financial conditions, since SVB went down, they have gotten looser or basically unchanged. We are seeing Treasury yields, as you've reported, go down, 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 and that is helping keep financial conditions looser. So if the Fed wants to fight inflation, that's something they have to keep in mind. The story about banks pulling back on lending standards, well, here's what's happened recently. This is only every month from the Fed, but you take a look at this and you can see that banks have tightened somewhat since the first of the year, but all this was before the SVB crash. This tightening significantly has almost not changed at all. So far, we are not seeing the evidence that people have been talking about. And I thought a kind of interesting note this morning, John, well, I had talked yesterday about that swap lines going out from the Fed and other central banks. The total amount of dollars requested was $5 million from the ECB, nothing from Switzerland, nothing from England, nothing from Japan. So it doesn't look like there's dollar funding stress yet.
Mike McKee, yet. Let's hope there won't be. Mike, thank you for that. AMH, thank you as well. Down in Washington, about 22 minutes into the session, positive 4/10 of this. Here's Abby.
Well, John, we do have that S&P 500 up a little bit on above average volume. The best sector, interestingly, materials up more than 1% for no particular reason, just broad-based strength for those stocks. Financials up 1.5%. JP Morgan, Bank of America, Citi, all up more than 2%. We also have First Republic off of its lows, down about 12%. And we also have news that Signature Bank has sent a letter to clients on that merger with New York Bancorp. Here's that Haven trade, though, that you and Daryl Cronk were talking about, tech and crypto. It makes no sense to me, but there it is, John. Big gains over the last week.
Abby, thanks for that. Your trading diary up next. Chairman Powell, just a few days away.
We can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
So far, so good. 25 minutes in, up a third of 1% on the S&P. Last week, big week of gains on the NASDAQ. We take some of that back. We're down about 3/4 of 1% on the NASDAQ 100. Some relief for the regionals. The banks, that's given the Russell a little bit of a lift, up by more than 1%. That's the price action. Let's get to the trading diary. ECB President Christine Lagarde speaks at the top of the hour on Wednesday. The main event, a Fed rate decision and Chairman Powell news conference, plus Secretary Yellen heading to Capitol Hill once again. Rate decision from the BOE, the Swiss National Bank, all coming on Thursday, along with another round of jobless claims as well in the US. And finally, rounding out the week with durable goods and PMIs on Friday. Looking ahead to Chairman Powell. A lot of people looking for 25, looking for a pause. Barclays, Credit Suisse, Goldman looking for a cut still. Nomura. More coverage still to come this week from New York. This was the countdown to the open. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines, because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was a native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today. And then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake.
right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas